Hello guys and girls, and welcome back here to the ChainLog YouTube channel. I'm ChainLog Analyst here, and today I'll take you through a new study case and analysis on the public debt of the US and the over leverage that is in the system. Also, I will make you see some new metric, some new calculation based on what are the basics of economics, some metrics that you never see, and with these metrics, with this calculation, I will arrive at a point to gauge, to actually assess what could be the outcome from the Fed if these metrics will continue their road, or if this metric will reverse. So now I'm making myself and I'm making myself to be in the upper right corner right here, and we'll start from the federal debt or total public debt of the US. This is denominated in millions right here. As you see, if you take the billions, we have 30,400 billions, or 30 trillions debt, more than 30 trillions of debt for the US economy overall. And if you take this in comparison to the GDP, that is actually at 24,486 billions, or more than 24 trillion. Actually, this is obviously more than the GDP itself. So the public debt is more than the overall production of the United States. That means that if every person will stop consume, eat, drink, and everything else for an entire year in the US, they couldn't repay their debt. Even in that case, they should have more than this, probably 1 year and 2 or 3 months without ever consuming anything, and just producing the same amount they produced. Meanwhile, they consume, eat, drink, and of the rest. So this instead is the total public debt as a percentage of the gross domestic product. And as you see right here, we are today at 124% of the public debt in comparison to the GDP. So GDP is 100, and the deficit we have in comparison to the GDP. So our public debt is 24% more than the actual GDP. This means that we are in an over-leveraged system, that we can't actually repay our debt, nor the US itself. But this is just a this is just you can take the US as an example of the other economies, because anyway they have more or less the same amount of debt that has reached in other countries, more than 124%. So actually this is just an example of the overall economy. Is this debt credit system that we are in today is not sustainable. So I'll take you through right here. I made this chart right here, that is the cost of capital, the yearly debt cost in billions. So this is I'll make you this is just the public debt in billions divided by 1,000 in billions, multiplied for the Fed funds rate. Okay, so this is the cost of the public debt that we pay based on the federal funds rate. So if the federal funds rate increases, we are paying a percentage, obviously, that is more than the previous, and so we are paying more debt. And as you see right here, we are in an uptrend every time we raise interest rates. We are getting to a point where we pay more billions every year for the same for the debt. But this is because the debt itself is increasing at an exponential rate. What's this sharp raise in the total debt since the left from the gold standard in 1980s? Watch how much we did in fact skyrocket on that chart. And every time the Fed raise interest rate on the Fed funds rate, that are this, every time they raise, as you see right here, Fed funds rates are actually declining, and meanwhile, in fact, the debt is increasing. But even if this interest rate, or the actual cost of capital of maintaining this debt, is decreasing as a percentage, is increasing as in the means of the billions. And you see this right here. Every time the Fed raises interest rates, we are paying more in billions debt to this to the Fed itself, because our debt is increasing. And this cannot obviously change. Meanwhile, we have this public debt increasing. Obviously, what I'm trying to say right here is probably that if we'll have to catch up to the federal funds rate to the point where we were, so the neutral, more or less 2.5% here, the effective federal funds rates, probably we'll see this trend continue. And probably we'll have overall not only the US but other countries also, because as you see in England we have 11% inflation, in Europe we have more than 7-8% inflation, I don't remember well, but more or less the same. And the public debt is increasing also there. And as you see, the obviously the outcome will be that we'll pay more capital to have the same debt as before, as per every rate hike. And probably we'll touch even 600 billion for years just to maintain the debt, not to repay the debt. I'm not talking about repaying the debt, because that we will see that also is most likely impossible. As of right now, is I don't see how a state could. But just we're just taking in consideration the cost of maintaining this debt without defaulting on this debt. And we'll see that we'll probably reach a point where we have $600 billion paid by the average citizens of the US just to maintain their debt and not defaulting on their debt. So let's keep on here. This is the yearly cost of capital as a percentage of the GDP. Okay, what does this mean? The yearly cost of capital, as I already said, that is this right here, cost of capital yearly as a percentage of the GDP. So you take this average cost of capital you have and you'll put it onto the average as a percentage of this GDP. So in the overall production is 24 trillions right here, and the debt, the cost of yearly cost of capital of maintaining this debt is actually 367 billion. How much it is in terms of percentual terms? As you see right here, it's 1.51% as of right now of the overall GDP yearly, just to maintaining this debt. That means that if you have if you are producing $100 of goods, you in reality, just because you have this debt, you are just producing $98.5 of goods, because 1.5 are actually the costs to that the state will take away from the producing the gross product itself, and will put it in the repaying of not the repaying of the cost of capital to maintain this debt. As it seems, watching it like this, it could seem that this is not very much. 1.51%. How much could it be? We had in fact also 5.8% of the GDP itself as per cost of capital, but you'll see that this is misleading as itself, as it is misleading watching just the federal funds rates as a gauge of how much of the debt we are actually paying over time, because these percentage terms are not taking in consideration the amount of debt that there is in the system right here, that is overall increasing at an exponential rate. And so the this much of billions still increasing every time we raise interest rate. And as you see right here, if we take the same amount, let's take first the taxes. Okay, let's make an example right here. If we have, for example, the tax, let's take in consideration the tax. We have in the United States 2.9 trillion of taxes every year, that as a percentage of the GDP are 11.95%, okay? Without considering any other taxes, just the basics taxes imposed by the United States to its citizens are actually from a perspective of production, not a perspective of actual earnings, okay? Nor a perspective of actual profit. We are taking in consideration the gross domestic product, or the overall production. So every single dollar unit that is actually put into the system from a good seller buyer perspective, in every case it is just going on the GDP. So as a percentage of the overall production, we have a 12% taxes today. We have 12% taxes on the overall GDP. And if you take this and you take this into the public debt, you see that the public debt less taxes in billions are actually more or less the same. You see right here, public debt 27 trillion. Meanwhile, public debt right here 30 trillion. We had 3 trillion of difference that are actually see, you just think 11%, well, is not very much as a percentage of taxes, but if you take these taxes in the percent of the GDP itself, it doesn't seem so much. But if you take in consideration that these are 3 trillion taxes, and of these 3 trillion taxes, 10%, or actually the 367 today, but we can go as much as 20%, of those taxes are actually going into the repaying of the debt, just to maintain this debt, not repaying, sorry, just to maintain the debt, not to repaying, because if you had to repay the debt itself, you'll have to take like 30, more than 20 in this case more than 11.95, so 15% of the taxes, and still meanwhile this is increasing, taking a percentage more of this capital out of the taxes to put into the repaying of the debt, and so raising obviously the costs of the services the countries, the federal countries have to have to put in the market, and so onto the average citizen. If you take this into perspective, as you see right here, we are in a spot where you cannot think about repaying this debt, but just to maintain its debt without even collapsing. And this is the work, the job the Fed is actually trying to do, and the government is actually so concerned about, and we analysts are so concerned about, because as you see right here, you have 12% of the taxes going into the 12% of the taxes of what 10 to 20% will be used to repay the debt itself, just to maintain it, okay? And where do you think the government is going to take the other money they need to make so you have your services as a state, as a United States, as a federal countries united in it's impossible to think about raising this kind of taxes and put it into the debt just to repay it, okay? It's just impossible to think. That you have to think on how not default on just having this debt, having repaid the cost of capital of this debt. This is taxes less yearly cost of capital, for example. So every time these are actually the taxes we saw right here that are 2.9 trillion. If we take out the cost of capital, you see better is like 10% is the difference. So 400 billion, 360 are actually taken out of the taxes to repay, to maintain the yearly cost of capital. So if you take in consideration instead the entire liabilities and capital, so the total liabilities there is in the system, or the overall liabilities there are, that is, for example, credit card loans, bank loans, mortgage loans, every single liability the average citizens has is calculated, is inside this metric right here. And if you take in consideration this and you put it, we are not talking now of the GDP or the public debt. We are just talking about now of the total liabilities there is in the system for the average citizens. This is not taking in consideration the public debt, okay? This is just another thing. If you take in consideration the Fed funds rate, this put mildly is 107 billion to be repaid every year at this time. And that this pace will continue to rise, obviously, like it raised the last time. The liabilities in the system were rising. And this means that if you take in consideration this is just the liabilities, the amount of fund rates of the liabilities, meanwhile this is just effective rates, is not taking into account the actual percentage that the commercial banks are actually putting on your loans. If you have variable percentage loans, if you have something like this, is an adjustable loan, I think they called it, you probably are going to pay very, very much in the next few months. Meanwhile, the cost of capital actually raised, because you have to know that the federal funds rate actually are not the rate that commercial banks put on your credit loans. They actually, the federal funds rate is the base on which the commercial banks are actually lending and borrowing to each others. So when you go to a commercial bank and you borrow money from them, they'll take this 1.21 in this case, this 1.21% loan. They loan this capital maybe from another bank, and they'll charge you maybe 2x more, so 2.5% to this loan, or maybe 4 times more. It depends obviously from the bank you choose, but obviously they are taking this into 5% on your loan. And the more we raise in the effective federal funds rate, the more the average consumer will pay, and that is reflected right here in the cost of capital. What's the difference from the cost of capital of in fact from the average citizen, that is increasing at a very fast rate every time. Meanwhile, we have the actual cost of capital increasing every time also, but in a slow and defensive manner from the cost of capital of the public debt. That's because in fact we are actually seeing that the liabilities from the actual liabilities that there is in the system are actually, they come actually from the average citizens. And when they'll borrow so much money all in once, all the debt, when the Fed funds or the federal funds rates are actually increasing, they will repay even more their debt. And this is just what it happens to the average citizens, and we're not taking consideration, as I say right here, this is just 1.5% of the total liabilities. If you have a 5%, you will have probably 3 times more, so you'll have to repay 300 billions. If you take 5%, 350 billions just every year as an overall cost of capital to maintain your debt. We're not talking about repaying debt here, we're just talking about maintaining the debt. So as you see right here, this is not actually it's not actually sustainable as a whole. So we are now arriving at the very last point of all of this talking I made. And what will be the actual outcome? What will be? So if we are taking into consideration that the GDP itself will keep growing, okay, so the GDP, the GDP right here will keep growing and will not get down. And this probably will not be the case, because as you see right here, if you take the real gross domestic product or the real domestic product adjusted by inflation, you'll see right here that we have actually a little bit of an downtick, because in fact the overall money supply are actually getting destroyed by the interest rate accumulated by the Fed raising interest rate, and so to put a stop of this inflation. But in the case, in fact, in the case of the GDP keeps growing, we'll probably we'll probably have this sustainable amount of money to get into the cost of capital to repay this debt, even if it grows even further. Okay, but in the case we are actually seeing a decreasing demand that leads to a decrease in inflation, but also in a decrease into the GDP, because a decrease in demand, that means that we'll have unemployment rate raising, and so more people unemployed, and they will have no money to buy things, so reducing in demand, that is with the reduction in supply that we are seeing as of today, from the supply chain issues, will bring down inflation, with the federal funds rate taking down inflation from the perspective of the creation of money in the money supply, as you see right here, as we have in the COVID itself that took us to this point. So the Fed itself should have to decide if keeping increasing the interest rate in this case, and arriving at a point where the inflation will be tamed, but only if the GDP will actually keep growing. In the case, in fact, that they reach their unemployment rate and the GDP will start decreasing, they'll have probably they'll probably need to stop with this hawkish sentiment, with this raising interest rate, and they'll have to pivot before it's too late, because here it's just a question of equilibrium in a system that is unstable. And if they go too much deep into raising interest rate, we'll probably see a recession we never seen before. They will not be able to just stop themselves and reverse the course, but probably they'll see a huge amount of people unemployed, a huge amount of capital, a huge amount of companies that goes bankrupt, and this is just an equilibrium they have to reach, and this is just very delicate as an equilibrium. And as you see right here, we have two possibilities. The Fed will keep raising interest rate to fight inflation and supply chain issues, lowering demand. If the GDP will grow, if the GDP will not grow and will decrease in time, we're seeing the Fed pivot as soon as this, for example, as the yearly cost of capital of GDP will increase and the actual cost of capital in billions will start growing too much outside of this line, for example, because the government itself will not be able to repay this debt with a decrease in GDP, and so a decrease in taxes, and so an increase in a decrease in taxes right here, and an increase in taxes as a percentage of the GDP. To repay the debt and not going to default, they will have to raise taxes that will be put on the average citizens another time. Every time is the average citizens that pay, and this will lead to more lowering demand, to more unemployment, to more people getting broke, and probably suicides and something like this. And this could grow into a situation that we cannot take under it will get out of control real fast. So this is the equilibrium they have to reach, and I think they'll start pivoting as soon as we take probably the effective federal funds rate will take to the 2.5%. The market is pricing in obviously something like this actually, because for example, as you see, the US 10-year Treasury bills right here are at 3%. That means that is more slightly more than 2.5%. They're taking into account the 3% because, as you see right here, that was the actual last hike on the yield of the 10-year bonds that are actually in a decline ever since, and they are pricing in this much, but probably they will start raising, and this US 10-year will start raising a yield as the 2-year that has effectively broke its previous downtrend. If the United States are actually seeing this much of a pressure from the Fed, and so the perspective of the US not being able to repay their debt will increase. So these two will actually get more. The treasuries of the US in that situation will get more risky. So the yield will raise. Meanwhile, most likely people will start selling those bonds. In this case, right here, we are seeing, and this is another metric to take in consideration, a reverse in the yield curve an inverse yield curve. That actually mean every time we raised above this trend line, after we actually dipped below, a recession, and every single time we dip below and we raise again, it was in a period of recession. As you see right here, I'm not taking in I'm not saying every time, but you can see yourself right here what happened. And we are in this case dipping below here and waiting to see to enter the recession, the actual recession right here. So this is it for today, guys. I hope you enjoyed the study case. I hope you enjoyed this content. Let me know if this content, if you like this content. Subscribe to the channel. Click the notification bells. Follow me on Twitter. I'm on Twitter. I'm posting and sharing everything I can find on these charts, on the crypto market, on the stock market, on the economy, overall economy itself. And you can actually see all my links into the description. I have this school for the newbies. If you know someone, it will be kind of you if you can advise my school. I'm actually making new courses, technical analysis courses, fundamental analysis courses, and also technical fundamental, and I don't get the other one, on-chain analysis. Okay, it was a lapsus. And on-chain analysis courses. For now, they are actually at $7.49, but with one free week trial. $7.49 a month to have the services, to have the alpha sharing, to have my daily updates on the crypto market and the stock market itself, not with every stocks but with the indexes, and dominance, on-chain analysis, technical analysis, everything I can find with the news. There is a news aggregator also. So this is and this will stay right at $7.49 until the 1st of August, then $15, $14.99, and until I have I've finished all the courses. And these courses will be available too for this price. When I'll end up I'll finish this course, these courses will be paid more, so you are still in time if you have any friends that is newbie to enter the service for this price, to learn meanwhile I develop these courses. They are on my Discord, on the ChainLog Discord, that is the school I have. You see the site in the description. And nothing, this is it. This is ChainLog Analyst here, and that greets you. Cheers.